Hello everyone, I'm Charles Ang from COL Financial, and I'm here today with our Chief Equity Strategist, April Tan, to give you an update about a local stock market. Hi April.
Hi Charles, good afternoon.
Okay, in our last market outlook, last January, I remember that we were talking about several reasons to be optimistic about the Philippine market, as well as some risks that could derail the recovery. But since then, markets have fallen significantly. So could you share what has changed?
Okay, so last January, we actually rallied by as much as 25% from the September-October low, on hopes that a Goldilocks scenario would happen, meaning that the U.S. economy would continue to grow and that the Fed would successfully address the problem of inflation. So that seemed like what was going to happen. Unfortunately, at this point, it doesn't look like that's going to happen. That's why the market is down by around 8.9% as of this taping that we have. Okay, so what's happening right now? The risk of recession, of course, is going up quite significantly. And I think one of the reasons why that is because of the recent banking crisis. Mm-hmm. Okay, so what happened is because of the significant increase in interest rates, the U.S. banks are suffering from huge hold-to-maturity losses on their investment securities. Of course, we know, aside from that, the depositors, because they're seeing interest rates on deposits going up substantially, instead of placing it in the banks, they're shifting their money to money market funds. So, of course, the reason why SVB, for example, collapsed is because they had a liquidity problem. The depositors were all going to money market funds, and because of that, they had to sell their securities, which were at steep losses, and then they didn't have enough capital anymore. So because of that, in general, banks right now are having that problem. So what is happening, although there are signs that, okay, the crisis has stabilized. So people might think, well, we're not having a crisis anymore because the bank runs have been controlled. Yes, that's true, but it doesn't mean that banks are okay or the crisis is over. Because of what's happening, the banks are actually tightening their lending standards. And if they tighten their lending standards, you'll have businesses that can't expand because they can't borrow money. And you also have individuals who, maybe they want to buy a house or they want to spend more money, but it's now a lot more expensive, so they can't borrow. So the tightening of credit standards definitely increases the risk that the U.S. will suffer from a recession.
All right. So you're talking about a greater likelihood of a recession in the U.S. Yes. And of course, that's unfortunate. But one silver lining there is that it could cause the Fed to pivot and to pause and pivot, right? And historically, this has benefited the market. So isn't that something to look forward to from the perspective of financial markets?
Yeah, Charles, that's actually a very good question. Because in the past, especially 2022, bad news was always good news. The market reacted favorably because, any indication that the Fed would actually start to pause and pivot, the market rallied. So what makes this time different? After all, the market seems to be implying that May will be the last time that the Fed will increase. And after that, they will pause and pivot, start cutting interest rates. Well, the problem is, in the past, people weren't thinking of a recession. They were just thinking of potentially slowing down the economy or slowing down growth. But this time, a recession is expected to materialize, or that will be the only catalyst for the Fed to actually cut rates. And, in the past, there have been several instances when the Fed actually started pausing and pivoting because of a recession. And when that happened, when they pause and pivot because of a recession, the market continued to go down. Mm-hmm. So if the U.S. falls into a recession, even if the Fed pauses and pivots, that doesn't mean the market will go up. It will go down.
All right. So that's the key difference. The pause with a recession, or the pivot with a recession, or maybe a soft landing, right?
Yes.
That's the best case scenario. All right. Now going to the Philippine market. So how different are we, or are we also vulnerable to the same threats that the U.S. is facing?
Well, okay, so interest rates in the Philippines are also up. Our BSP was also very aggressive. Well, the impact of a BSP rate hike is less significant in the sense that, well, of course, the U.S. came from 0.25%. We came from 2%. And that said as well, the local banking sector, financial sector is less mature. For example, even though the central bank, for example, cut interest rates during the pandemic, we never saw lending rates really go down, right? Especially if you're a consumer, it was still very expensive to borrow money. So we don't have that benefit that happened in the US because the country is less mature. And of course, coming from a high base, you increase it by, say, 400 basis points. The impact, say, from 4% to 8% is just times 2, whereas the US came from 0.25, then you're increasing it to 5.25. That's like what? Almost 20-fold increase. So the difference is not as much in the Philippines. Secondly, during the time when there was an SVB collapse, we did a study on the banks, and based on the disclosed losses, held to maturity portfolio losses as of end September and December, potential losses is around 11% of the capital base. So even if we take that out, the banks are still meeting the 10% minimum capital adequacy ratio requirements of the central banks. And then aside from that, the banks are largely dependent on low-cost deposits or transactional deposits, which don't really move to money market funds. So this is like 78% of all deposits. And aside from that, the good news is, okay, our inflation after peaking at 8.7% in January is also starting to go down. And the BSP governor already said that if the inflation continues to go down for the month of April, they might pause already in May. So that's definitely good news.
I see. So you mentioned the potential pause in interest rate hikes for the Philippine market. Is this in any way related to the weakness of the peso that I've noticed recently? Like, what are your thoughts on the
Yeah,
peso?
I mean, that might be the reason why the peso is weak, no? Because, again, the Fed is expected to continue tightening in May, whereas the BSP might already pause in May. That's why I think the peso is weaker. But I guess the question is, so does that mean now that the peso is at 56, it might end the year at 60, you know, or it will continue the downtrend? I really don't think so, because it looks like the U.S. will be in a much weaker position. For example, this year, I think the chances that it will fall into a recession is very high, whereas I think the GDP growth in the Philippines is still going to be positive. So if you compare the growth of the two countries, and of course, I don't think our BSP will be cutting rates significantly, because probably it's just going to normalize, whereas the Fed might actually cut rates to a very accommodative level. So in that respect, I think the peso's weakness is probably more temporary.
So from the looks of it, I think you explained several reasons why the U.S. economy and also their financial system, their banking system, is in a different boat, in a worse position compared to the Philippines, right? Is that a fair statement?
Yes, definitely.
All right. Now, I remember again last January, one of the reasons why we're positive about the Philippine market is because of the attractive fundamentals, the strong earnings, coupled with the underinvestment of the foreigners, right? Are these things still true today, despite the markets, correcting significantly?
Yeah, definitely. I mean, okay, so if we were cheap at a much higher level, of course we're much cheaper now. We didn't really see a lot of earnings revisions on the downside because corporate earnings were quite strong. We're now at the 6,500 level, and at the 6.5 level, we're actually trading at around 12 times PE. So that's more than 2 standard deviations below the mean. Meaning, I think there's like a more than 90% chance that it can go up if we were to look at the record of the market the past 10 years. So that's true. And then as far as foreign buying and selling is concerned, after a brief period of net foreign buying in January, net foreign selling materialized again in February, March, and April.
Yeah. And just to be clear, you're not expecting a recession for the Philippines and no earnings contraction as well. Is that correct?
Yes, that is correct.
All right. Okay. So, given everything that we talked about so far, what is your investment advice for our clients?
Okay, so I think last January I talked about what I felt was, an ideal mix. Assuming, okay, there's what you call a 60-40 portfolio that they talk about. If you were following that type of a portfolio, I think having a little cash on hand would be good, a little bit of dry powder. But that said, okay, but what if, the U.S. goes down? Like as they say, if the U.S. Sneezes, everybody catches a cold. Yeah, that's true. But, if I'm looking at the valuations of Philippine stocks, they're just too cheap because, everybody's just been too bearish. So what if we don't really go down anymore? So I think, it's a good time to buy or to keep invested in stocks. But I also like bonds because, okay, if the U.S. falls into a recession, and of course, if the U.S. falls into a recession, inflation will no longer be a problem. And in the Philippines, we're already seeing inflation, going down. So if you own bonds, actually, you benefit when inflation goes down, when the economy weakens and interest rates go down, then bond prices go up, and of course, yields go down. So if you're a bondholder, you are able to lock on to higher yields, higher income, so that's good. Okay, so what kind of stocks do we want to buy? That said, yeah, there could be some downside, but if you're going to buy stocks, better to stick to those that are already cheap, so your downside risk is less. And then stick to larger cap issues because those will be the first one to go up when the market turns. And then maybe focus more on defensive sectors because they're less vulnerable to risks that may materialize because of what's happening overseas. And stick with those that give some cash dividends, so it's easier to be a long-term investor.
I see. So a lot of different advices there, So can I just clarify, when you said to keep some dry powder, do you have like a particular percentage in mind? Like how much is enough, I guess? I know this can't satisfy all of our clients, right? I mean, it's on a case-to-case basis, but like as a rule of thumb, as a like starting point, how much cash should we have?
Yeah, maybe if you have a portfolio, maybe 20% would be good.
Yeah, okay.
Yeah?
Okay.
Just in case the market goes down sharply. Remember March 2020 when the market fell sharply. If you don't have cash, then you would not be able to take advantage of that very rare opportunity where, the market was just sold down so sharply,
Okay. So could you share some of your stock picks?
Okay, so actually I have more or less the same stock picks as before. They can read it in my Calling the Shots report. But, we have a new stock pick. One of our new stock picks is AREIT. The reason why we like it is they have a new acquisition that will come online maybe 2024, but that will add around 22 billion pesos in terms of assets, and their dividend yield would also go up because of that. And right now, because AREIT went down to around 32 pesos, the dividend yield is very attractive at 6.6%. And of course, we like the sponsor of AREIT, Ayala Land. They have a lot of assets that they can still inject into AREIT. And AREIT is less exposed to the office sector that is currently suffering from, a lot of issues. But that said, I mean, okay, what if I only have money to buy a few stocks? Because that's what they always ask me. So if we were to pick only 5 stocks, I would suggest AREIT, Aboitiz Power, SM, Jollibee, and DNL. Because, of course, they fit the criteria that we talked about. They're attractively valued. They're large caps or mid to large caps. They give cash dividends, and they're pretty defensive because we're focused on power and consumers, and of course, a dividend play, which is like a proxy to the bonds, which is a REIT.
All right, there you have it. Thank you so much, April, for your time. We hope that we were able to give you some insights to help you in your investing in the coming months. Remember to keep some dry powder just in case something happens, something worsens in the US. And at the same time, don't be too bearish because of the attractive fundamentals and valuations of Philippine companies. For more guidance, you could check out April's piece, which we publish every month in our website. Thank you for watching.